Hello everyone, welcome back to another edition of It's the Economy Stupid, the show where we take those big confusing macro stories, strip away the jargon and serve them in simple and plain English. I'm your host Kashish Kapoor and you know the drill. Numbers might sound boring, but trust me, there's always a big story hiding behind them. Today we're diving into RBI's latest bold moves, growth data that's giving everyone mixed signals, and about housing. Yes, the one thing that every Indian loves to argue about. Here's what's on the menu today. First, the RBI's CRR cut, what it means, why they did it, and whether growth can still bounce back. Second, I'll talk about the growth puzzle. Is 5.4% just a bad quarter or the start of something worse? We'll break it down step by step. And finally, I'll talk about the housing boom. Loans are up and prices are rising, but it's becoming a treat for investors and a pain for home buyers. So whether you're a market nerd like me or just someone trying to keep up with what's going on, let's dive right in. For the first story, in the first week of December, the Monetary Policy Committee, that's MPC, did exactly what everyone expected. Absolutely nothing with interest rates. The repo rate still sits at 6.5%, which kind of makes sense. You see, inflation is tricky, growth is shaky, and the RBI doesn't want to rock the boat just yet. But they did not completely go silent. They cut the cash reserve ratio, that's CRR, by 50 basis points. That is 0.5% for all the non-finance folks out there. This move could quietly add over $13 billion of cash into the banking system. Now, how does that work? Let me tell you. CRR is the percentage of deposits that banks are required to park with the RBI. It's like a safety cushion, the cash that banks can fall back on during tough times. By lowering the CRR, banks now have to keep less money locked up with the RBI and can instead use that extra cash to lend or invest. Think of it as giving banks a little extra breathing room to boost the credit flow. Now, let's quickly rewind what had happened up until now. In the pandemic's early days, the RBI had slashed the CRR to 3% from 4% to keep banks flush with cash when the world was falling apart. Once the worst was behind us, they hiked it back to 4.5% to soak up all the excess liquidity. And now, what's happening right now? They've dialed it back to 4% again, taking us right back to the pre-pandemic times. So why is RBI doing this right now? Because there has been a liquidity crunch lately, and one of the big reasons, ironically, is the RBI itself. What we are seeing is, over the last few weeks, they've been dipping into our foreign exchange reserves to support the rupee, which has been under pressure thanks to foreign investors pulling out from the Indian markets. This is something we've talked about intensely in the Daily Brief show as well. This drains rupees out of the system, making liquidity tighter. But that's not the whole story. There's another reason to it. Falling small savings inflows are making things even worse. Small saving schemes like the Public Provident Fund and Sukanya Samriddhi Yojana and many others are a key funding source for government's fiscal deficit. This year, however, inflows have been falling fast. In October alone, net inflows dropped 25%. And for the first 7 months of FY25, they're already down by 30%. Now, if this continues, small saving inflows could fall 93,000 crores short of the budget estimate. Now, what does this mean? This means that the government will now have to borrow more from the market, and that's where things will get tricky. Higher government borrowing will crowd out liquidity as they'll be competing with companies and retail borrowers like you and me for funds. And when the government takes a bigger slice of that pie, there's less credit left for everyone else. In fact, if you look at the data, the money market liquidity has already flipped. What was once a large surplus since June has now barely balanced out. So the CRR cut feels like the RBI's way of balancing the scales, easing liquidity without causing all the problems by slashing the rates. Now, despite all of this, the biggest takeaway from the meeting is how relaxed RBI was about the growth. You see, they trimmed their FY25 GDP forecasts from 7.2% to 6.6%. But most of the slowdown came in the first half of the year, where growth slipped to a disappointing 5.4%. Yet, the RBI remains optimistic. They're betting that on the second half, recovery will be high, expecting growth to bounce back to 7% year on year. Basically, they're saying, relax. The dip was just a blip. In fact, they're so confident that they stuck to their neutral stance. No hints of either rate cuts or hikes. And with Shaktikant Das stepping down as the RBI governor and Mr. Sanjay Malhotra taking over, this becomes even more likely, even though Mr. Malhotra insists he's staying neutral for now. So what's next? It all comes down to the growth data over the next couple of months. If the recovery doesn't look as solid as the RBI is hoping, they might have no choice but to loosen the purse strings further. Until then, we've got the CRR cut to tide us over. Now, on to the next story. We ended the last story saying growth is taking the center stage for all our policy decisions. And why not? Now, here we are staring at the GDP numbers for the September quarter, and there's no sugarcoating this one. Growth slowed sharply to 5.4%, down from just under 7% in June and a solid 8% in the same quarter last year. To put it bluntly and very straightforward, this is the slowest GDP growth we've seen since the December quarter in 2022. But does this mean the economy is wobbling again? Or was the slowdown just a temporary blip as RBI said so? That's the real question, and the answer, as always, lies in the data. And this is what we'll talk about. Data was already hinting at what is about to come. Let's face it. You see, quarterly GDP numbers aren't all that surprising. It's like getting the bill at the end of your restaurant meal. You knew what you were ordering, how much it costs, and the bill just confirms it. Most of the data that feeds into GDP, like disappointing corporate earnings, muted consumption trends, and falling tax receipts, was already signaling a slowdown. Let us take a closer look at this, starting with the government spending. October offered an interesting mix of data. On one hand, government spending shot up by over 15% year on year during the August-October period. But all the growth came from revenue expenditures, that is day-to-day expenses like salaries and subsidies. Capital expenditure, which drives long-term growth, actually fell by 10% year on year, marking the third consecutive monthly decline. This is not at all a healthy sign to see capex falling behind this much. Even worse, on the income side, the tax revenue numbers are looking weak. Gross tax revenues grew by just 2% year on year, while corporate and personal tax collections both declined in October. In fact, over the past 3 months, tax collections have barely grown at 1% year on year. You see, if this trend continues, the government will likely miss its full year revenue targets and may have to cut down on spending, something we really can't afford when growth is already slowing down. So while the government budget isn't doing much to support falling GDP, the high-frequency consumption data may offer some much-needed relief. Let us now look at them. Let's first talk about automobiles. Consumption in the auto sector is showing signs of a turnaround. Yes, the timing of the festive season shifted some demand, but if we strip out the noise, the numbers are still very solid. Cars and SUV retail sales grew 11% year on year over the last 2 months, a sharp recovery from 2% decline in September. Two-wheeler sales also rebounded to 24% year-on-year growth, up from a modest 5% in the previous quarter. Even tractor sales grew 15% year-on-year after falling 7% in Q2. This shows that the rural pulse is also strong here. Second, I want to talk about power generation. Power generation growth picked up slightly, growing by 3% year-on-year during the October-November, better than 1.4% growth in the September quarter. It's not a boom, but it's not stagnation either. Finally, I want to talk about cargo throughput. Not everything is rosy here. Cargo traffic at major ports continues to struggle. November marked the second consecutive month of decline, the first such drop since June last year. Most of the weakness came from lower throughput of coal and iron ore. Even container traffic barely grew, rising by just 1% year on year over the past 2 months. That's a sign of sluggish trade and industrial activity, something that cannot be ignored. So the big question remains, is growth bouncing back? Here's the thing. The RBI and the MPC have been optimistic, brushing off the 5.4% growth in Q2 as a temporary blip. And to be fair, they might have a point. The high-frequency data from November suggests some recovery, particularly in consumption-driven sectors like automobiles and power generation. But there are still big challenges. Government spending still needs to fire on all cylinders, especially capital expenditures. Tax revenues need to stabilize, or else growth could take a hit if the government is forced to cut spending. And finally, weak industrial data like cargo throughput is still a concern, and we still need to closely monitor that. For now, the MPC's confidence doesn't seem completely misplaced. The early data signals a recovery, but the scale and sustainability of that recovery is what we need to watch over the next few weeks. So is growth back on the menu? The signs are there, but we still need a little more data to call it a comeback. Now on to the next story, how housing is having its own moment. Let's change gears for a moment and talk about something that gives every finfluencer sleepless nights, housing as an investment. You know the drill. Stocks are flashy, Crypto is cool, but housing, it's that boring old school asset class that somehow keeps chugging along. And guess what? It's quietly having its own moment. While everyone's glued to equity markets, the housing market has slipped into a strong phase of its own. Property prices are rising, though you won't know it from the official indices, which are notoriously bad at capturing this ground reality. Why? One possible reason is that they don't account for the cash transactions that still form a significant part of property deals in the Indian market. So while the official data underplays the action, the on ground reality is far from robust. So if the official indices don't do the job well, where's the proof of this booming housing? The answer lies in an unlikely place. The RBI's inflation expectation survey conducted across major cities. And this time, the optimism is off the charts. Nearly two-thirds, that is 67% of respondents, expect housing prices to accelerate, the highest level of confidence we have seen in over a decade. On the flip side, only 2.5% of the people expect housing prices to actually decline, the lowest we have seen in the past decade. Clearly, the housing market is defying all the don't buy a home memes floating around. And this confidence isn't just a sentiment, it's showing up in the numbers. It's no surprise that housing loans have been growing fast over the past year. Back in July 2023, they were rising at 13% year on year. But by October 2024, the number had climbed to 18%. And you know what? It's not just homes. Even commercial real estate loans have taken off. Growth has doubled, jumping from 13% to 26% in the same period. Whether it's buying houses or building malls and offices, everyone's borrowing, and banks are happy to lend. You know what makes this even more interesting? All of this is happening while overall bank credit growth for the entire banking sector has actually decelerated. So the sharp rise in housing and commercial real estate loans is standing out, highlighting the sheer strength and momentum of the property market at play here. But here's the flip side too. The rise in housing demand isn't without its consequences. As more people treat homes as just another investment vehicle to park their money, the very purpose of housing gets diluted. Prices rise, making it a lucrative asset for investors, but at the same time, it pushes home ownership further out of reach for most people who actually need a roof over their heads. For families looking to buy a home to live in, what was once a dream is now starting to feel like a luxury. So that's all the data-backed macro stories for this edition. I'm your host, Kashish Kapoor. It's The Economy Stupid, and I'll see you in the next one.